We are going to talk to Cleat about that and so much more involving their pursuit of Warner Brothers Discovery. In the meantime, it's an obvious question. Was last week's wild volatility all just a dream or maybe a sign? Let's bring on the floor show and B. Riley Wealth Chief Market Strategist Art Hogan. Hi, Art. I mean, look at the daily moves in the Dow last week. I wasn't even here, and I kept looking and thinking, what is going on? I mean, 1 minute, you're way up. You're jumping on Monday up 515 points. Then Tuesday was the ugly day, right? We've got Tuesday down 166 points, and then it goes on and on. Is this a classic lesson that buying the dip still works?
I think it is, Liz. It's also, buy the market when Liz gets off the slopes. And I think that's exactly what we're waiting for, getting you back from skiing and paying attention to what really matters here. And I think that one of the things that we ran into over the course of the last couple of weeks, and last week is no different, is it's not just the concern about how much money the big hyperscalers are spending on CapEx. It's will AI actually disrupt software? So last week was really all about the software Armageddon, where everything that was related to software was for sale. And there's an ETF, the IGV, that basically represents all of the software sector, and that got so oversold that it was at its lowest RSI, or relative strength index, since they invented the ETF. So that just basically means that in a short period of time, the selling was overdone. The people who look at that technically came in and bought, and that's why we saw the Friday bounce in software and all things technology related, and we're still seeing some of that momentum coming into the market this week. So we go through these periods that we're afraid the sky is falling, and the last week's major concern was that all software would be disrupted by AI, and I guess clearer minds have sort of come back into the market both on Friday and today, and it feels as though we're being a little bit more rational and certainly a little more discriminate about how we're thinking about those things. Were
people wrong to rotate out of technology? That's the big question, because you saw that top-heavy trade in high-tech, semis, software, although software has been questioned lately as to whether the viability in the future is really something, especially considering you've got the Anthropics of the world coming out with all kinds of workarounds for software. But was it wrong then to go into, say, industrials? Caterpillar was a great performer on Friday, has been a pretty strong performer as well.
Yeah, Caterpillar's doubled in the last 12 months. And the rotation into industrials, materials, things like utilities that we saw, most of the fourth quarter and all of last year and into this year, it makes sense to see this market broadening out. We're also seeing investment in small caps. So we spent the better part of 2 years coming into last year where it was just technology and communication services. It was just 7 stocks, and we didn't pay attention to the other 493. In the fourth quarter of last year and starting this year is when we're starting to say, what else could actually work here? What else are we missing? So that doesn't have to be at the loss of technology. And I think when you look at some of the names and the damage that's been done, NVIDIA, for example, which will report in about 3 weeks, NVIDIA is trading at a 23 multiple on a forward 12-month basis, which will clearly go down once they report and up their guidance. And we've already heard from all of the biggest customers about how much they're spending, and most of that's going to NVIDIA. So I think you can throw the baby out with the bathwater sometimes in these rotations and start selling stocks beyond where they need to be. And I think that's true in a lot of the semiconductor names and certainly a lot of the software names as we enter this week.
Well, if you bought the dip, let's just say, in another momentum trade that we've been following, and that would be silver, gold, obviously. If you bought that, you look pretty strong, at least today. You've got silver at the moment gaining 8%. So I think it's hard for investors, once they get nervous about, say, for example, what we saw on Tuesday, which was the Dow, or Thursday, the Dow losing nearly 600 points, and looked like a big capitulation at that point. They think, oh, wait a minute, is it over now? But you're saying still that the buy the dip theory is to be followed?
Yeah, I would tell you why, and I believe that's true. And I think that the reason for that is fundamentally backed. If we look at the earnings reporting season thus far, we've seen 80% of the companies that have reported, about 300 S&P 500 companies included in that, beat earnings. 70% have beat on revenues. More importantly to everything is 56% of companies have guided higher for the calendar year of 26. So fundamentally, we have earnings growth. That should be driving prices, and we don't even need multiple expansion to get this market to move higher. I think when you take a step back and take a deep breath and look at the fundamental backdrop, estimates for GDP for this year are certainly higher than they were last year, and earnings are certainly growing in low double digits. According to consensus. And I think that fundamental backdrop will continue to be why you want to look at sell-offs as buying opportunities.
Well, yeah, I mean, so far with the S&P companies that have reported, 77% have beaten on earnings per share. I believe 73% have beaten on revenues. So the analysts are a little off. I don't know, or these guys are under-promising and over-delivering. But Art, great to see you. Thank you so much for coming on.
Great to have you back. Thanks so much.
Yeah, that was a crazy Friday, wasn't it? 1,206 point gain.
Unbelievable.
Crazy.